Hello and welcome to another episode of Monday Macro View. This is Osama Rizvi coming to you from Primary Vision Network. Last week was a very interesting one. There were a lot of new reports coming out. One of the most important ones was, of course, IMF's World Economic Outlook, the revised and latest version. Of course, then we had OPEC's assessment of the oil markets, and then we had the IEA saying something about the global oil demand and everything. But today I'm going to focus upon what did the IMF say, where does it stand in terms of the future of global economic growth or recovery, and primarily I'm going to look at some indicators and see where do we stand in terms of the recession debate, because frankly there's still a lot of confusion. People are in denial of something. They're looking for reasons that shows a soft landing, that show that we have averted a recession, but unfortunately the real indicators that we're going to go through show the opposite side. So starting off, the GDP of the US economy, the fourth quarter GDP, the estimate was 2.6% growth. It was somewhere around that. So there was an article in Forbes. It went through a little bit of indicators, about 15 of them, and they graded each indicator either good, bad, or neutral. So that was a good one. However, rest of the indicators aren't really good. Look at the CPI. CPI year-on-year growth was 6%. Increase was 6%. That's not good. There was a fall of 4.4%, but that is when we compare it to the recent peaks. Of course, that is not a very good way of looking at things. So CPI, bad one. Also, manufacturing PMI, it stands at 46.3%. It came down 1.4% lower than the reading of February, and this is the fifth consecutive month of contraction. And this trend has started from June 2022. So we see that anything below 50 is symptomatic of contraction, and this is 46.3. This is something that we don't that isn't promising in terms of the health of the US economy. Furthermore, new export orders have also fallen. It stands at 43.7%. It's an 18 percentage point decrease from the 61.7% reported in February. So what has happened? Meanwhile, the job growth number has increased. Other factors are set to be positive, but what's happening to the new export orders? Why? Because this shows the underlying weakness in the global economy. Similarly, imports, that also shows the strength of the consumer side or the demand side. That is also down 43.6%. Look at the inventory sentiment. So ISM Inventory Sentiment Index has registered an increase of 57.9%. It stands at 57.9%. And 11 industries have reported that their inventories remain too high, quote unquote. That is for March. Why? Because there isn't enough demand for their products. So the real side of the economy, the manufacturing, the exports, the imports, the sentiment of inventories, the retail sales, these all show that there is something wrong in the economy. And I'm just trying to say, I'm not trying to be a doomsayer, of course. I'm just trying to say we might not be out of the danger zone yet. Furthermore, moving forward, look at the NFIB Small Business Optimism Index. It has decreased 0.8%. And this was to 90.1%. This is the fifth consecutive month below the 49-year average of 98. Look at the right-hand side on this of the chart. You see plans to increase employment on the downside. Expect real sales higher on the downside. Current job openings on the downside. Credit conditions expected to be better on the downside. A good time to expand on the downside. So most of the indicators are on the downside. And AHB's housing market index, it is below 50, well below 50. It has remained well below 50 from quite a few months now, just slightly hovering above 40. So that also shows weakness. Moving forward, the job market is performing exceptionally well. Employers have added back about 22 million jobs lost during the early weeks of the pandemic, which is really good. However, there are now analysis out there that as the banking lending crunch starts to hit the economy, as interest rates will continue to hold for longer and they will be higher for longer, it might spill over into the job market as well. We are seeing the number of people who have filed for unemployment has increased a tad, but still they're quite low in terms of when we compare it to its peak, which was in pandemic or just after that. But still, I think we will see some sort of weakness coming up in the job market as well. Overall, the age indicators came out to be as bad. 4 were neutral and 3 were good. So the neutral ones are also on the lower side. So the point is, we're not out of the woods yet. We are still in the thick of it. I believe all the indicators show a very clear picture. I mean, even the IMF endorses this point, that the indicators are still saying the US inverted yield curve. They're at one article read, they're screaming recession. If not screaming, but they're certainly whispering it to people who are listening. So our plans, our business ideas and executions should take into account this. I would not call it a tail risk, but a risk now. Finally, the IMF has warned of a recession as well. Report was a little bit realistic this time. IMF says the global inflation will decrease, however, more slowly than initially anticipated. And they see it decreasing from 8.7 in 2022 to 4.9 in 2024. Once again, there are lots of moving elements to this, lots of ifs and buts, lots of factors that have to go in tandem with their expectation. And I don't see that happening given the uncertainty prevalent across the markets and geopolitical spectrum as well. But United Kingdom is an economy, UK's economy will still continue to face challenges. It will fall about 0.7%, something like that. The advanced economies will face more challenges as per the report as compared to the emerging economies. However, the emerging economy face a heightened risk of debt distress, about 44%. This has been going on for quite a while now. Also, the one of the charts that you can see in front of you, it showed a very good snapshot of the global economy. You see that the manufacturing output has just started to creep up, if you talk about of the world, above 50. That of the emerging advanced economies still remain below 50. Look at the consumer confidence index. That is well below 50 of all the regions, world, United Nations, Eurozone, and China. You can tie this down with what's happening with the inverted yield curves. The expectations, the inflation expectations, look at the global inflation tracker of Financial Times. The inflation expectations still remain high, and the overall thinking about uncertainty still remains high. Hence, it is showing in these reports. That's all from my side. We'll be covering about other reports, OPEC and IEA1 in the EIA show this week. And I'll see you all next week. Thank you so much for watching.